本期内容比较小众，听见资本为您带来的是大摩根士丹利在4月3日关于美妆行业的闭门会，全球美妆市场正遭遇逆风，增长几乎全面放缓。想知道为什么吗？来听听顶尖分析师的深度解读。美国市场消费者捂紧钱包，零售商库存积压，新关税更是对某些品牌带来直接冲击，风险不容小觑。欧洲市场情况类似，彩妆销售明显降温，即使行业巨头也面临增长压力和严峻的同期对比。中国市场高端产品的热潮正在退去，价格战异常激烈，大众品牌趁势崛起，整体环境挑战重重，但也有本土品牌逆势增长。韩国市场注意了，对美出口这个增长引擎正在减速，关税阴影笼罩，关键的免税渠道也陷入困境，高端品牌复苏前景不明。日本市场复苏乏力，本土品牌在全球失宠，现在还要面对美国市场放缓的新担忧。这次会议将揭示分析师们对各个市场的谨慎判断，具体的风险警告，以及在当前充满挑战的环境下，他们认为的少数潜在机会。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Sorry, good afternoon, everyone. Welcome to join our JAXA call today. I'm Sharon Jiang, part of Morgan Stanley Global Sales Team in Asia. JAXA Pulse is an ongoing series we do for a cross-country read across for the most relevant current topics, and today we'll be focusing on global beauty products. On the call with us today, we've got our consumer analysts across the region, so Dara, Sarah, Kelly, Sato-san, Dustin, and our colleague from Asia Delta One team, Denise Chen, to give us a quick update on their latest view and how to play the theme in each region. Please note this webcast is for Morgan Stanley institutional investors and financial advisors only, not for the member of the press. If you are a member of the press, please disconnect and reach us separately. Please also note Denise is part of institutional equity division rather than the research division. Her view is her own and it may differ from the Morgan Stanley research view. If you have any questions, please remember to submit in the chat box on the webcast page throughout the session, or simply reach out to me on Bloomberg. We'll address them in the end of the call. So without further ado, let's move to our speakers. Dara, over to you. Thank you.
Hey, good afternoon, those in Asia, and good morning in Europe and the U.S. I'm Dara Mohsenian, Morgan Stanley's household products analyst, including the beauty names in the U.S. as well as beverages. And we thought first we'd start just going through a regional overview of what we're seeing in each of the regions from a beauty perspective, and then we'll come back to you with some individual stock picks within our sectors. I'll start with the U.S., and what we're clearly seeing is a broader beauty industry slowdown. Q1 is a quarter that has easier comparisons, and we're not seeing trends rebound sequentially. Things have gotten a bit worse. That's true in both the prestige as well as the mass side of the businesses. And just for perspective, we do get very frequent data, particularly on the mass channel in terms of scanner data. We get weekly scanner data that's delayed about a week and a half, but gives us a pretty good update on the market, as well as panel data from Numerator and other sources that helps us understand what's going on behind the numbers. So we've seen beauty weakness in general. I think that's particularly true on the U.S. mass beauty side, where you haven't had as much successful innovation this year in the cosmetics category. And in terms of what's driving that, in general, we've seen weak trends across staples. That's true particularly in a category like beauty that's a bit more discretionary. Some of that is lower income consumer weakness after inflation from recent years. There's also clearly been lower spending among the Hispanic consumer post-elections, given some of the political uncertainty there. So those are things that have driven near-term weakness. What I'd say is you're likely to see a U.S. retailer inventory level overhang. Again, this is true to some extent in broader staples, but I think particularly in beauty, given some of the weakness we've seen that's above what was expected by the companies and retailers over the last few quarters here. Clearly, with the tariff situation that was announced yesterday afternoon in the U.S., there'll be worries about a broader economic slowdown. That's likely to weigh on this sector a bit more. That's clearly more discretionary than staples in general. So we're generally looking at pretty subdued trends here. Again, I note mass cosmetics is particularly weak. And again, I would also note that there's probably some retailer inventory overhang that lingers over the next few quarters. So that drives us to be cautious generally within U.S. beauty as a sector and also the individual names, which I'll come back to. But let me turn things over to Sarah for an update on Europe.
Yep. So good morning, good afternoon, everybody. Kind of similar picture in Europe. We see a sort of fairly clear sequential slowdown in the scanner data, particularly in makeup. Skincare actually has had a little bit of an improvement in recent scanner data. One of the things that's also going to be important from a Europe perspective is sun care. Traditionally, this is a big period for selling in the sun, but certainly for some companies, the comparable, particularly someone like a L'Oreal, the comp is very, very tough in terms of sun care sell-in for Q1 and even for Q2 as well. More broadly, we hosted an investor trip a couple of days ago to Intercos in Italy. It's it's the largest cosmetics outsourcer globally, manufactures for pretty much any brand you can think of. It is tending to be on the more like masstige and premium side of things, and it is largely cosmetics focused. One thing, their general view on the market was, the US is a bit soft. They're not panicking about the market. What they highlighted was that particularly in cosmetics, when the market is soft, you get a higher degree of innovation from the companies. That tallies strongly with what L'Oreal's been saying in terms of, more innovation to try and drive demand. And innovation tends to be outsourced because companies, particularly now, don't want to take the risk of creating a new kind of tooling line for a specific line of eyeshadow. So they will tend to outsource. And so Intercos actually is benefiting from that step up in terms of innovation. But obviously, that's kind of slightly counter to how the market is developing. Elsewhere, and the team will talk in a second about Asia, but we are still seeing some evidence of destocking in premium in China. But sort of globally, fragrance and skin/hair seem to be doing better than cosmetics. So with that, I'll hand over to the Asia team.
Thanks, Sarah. This is Dustin. So for China Beauty, I think our view is still the same. Like we call out the over-penetration for prestige brands like during 2019 to 2022. That's still a reason for like China market overall with the prestige category in beauty still not under some pressure, and plus the weak macro, that doesn't help. So like if you recall in 2024, the beauty category was down like 1% in sales, and then in second half that was down like about 4%. According to the MBS data, January, February, that was up like 3%. So some sort of improvement there, but we still think that the overall industry will still grow slower than the GDP growth in China, and still less slower than most other consumer category that our team cover. I think one of the big pressures coming from the ASP decline, because thinking about this, like mass brands in general are still gaining share, and mass products are much cheaper than the prestige. So I think in terms of the mix change, that ASP is really bringing down the overall retail sales. So I would say actually from a volume perspective, it is not that bad. Volume probably still continue with the penetration story, but the overall retail sales, I think the pressure is still there. In terms of the price competition, that's still like extremely intense across platforms, across KOLs and live streamers, and across brands. I think earlier, a month ago, we put out a note highlighting a news that Tmall seems to be thinking to sort of not focus on the price comparison, and would even support some brands to do marketing outside Alibaba ecosystem. For instance, like help brands to invest in marketing in Red Note, even in Douyin. So to support the brand to grow, and then they think that the logic is that Tmall eventually will still gain about 30 to 40% of the share from like every beauty brand. So helping brands is helping itself. That's what the news suggested. But during the results, we checked the company. They don't see such a thing as happening. At least that hasn't happened during the Women's Day promotion. So I think my take is that maybe there are some of the softening in terms of the like platforms competition, but that probably will still remain pretty intense. And in terms of the market share, like in China, I think we've been saying this, like mass continue to gain share over prestige. But I think there another angle is that sort of the mid-sized brands, that can find its own specific drivers can also get market share. One of a good example is the recently listed MGP or Mao Geping. This company, being very successful, like deliver 30+% sales growth. Company target at the 30% sales CAGR in next 3 years is a prestige sort of positioning, and it is successful in makeup and in prestige, and also successful in offline. Like its offline can even growing at a double digit is very impressive, and this company is like operating with like 40% operating margin. So this is a kind of an example that put into a context that it's a very tough environment. Some company find its own driver. If the size is not that big, that can still grow. Same thing to other brands that we don't cover, such as that Chic Max with about like 7 billion revenue, not small anymore, but companies still commit to like 25% plus sales CAGR in the next like two years or so, and with the main brand to target with the growth of 20%. This company also having healthy like margin, like OP margin at about like mid-teens. I'm going to spend a little time on Giant Biogene in the second round of this call, but Giant Biogene is also a name that we like, and also delivered very strong growth last year. Company also target good growth, like 25-30% growth this year. So although overall industry we kind of having this like I would say conservative to bearish view, but under the hood there are still some of the bright spots. So with that, let me hand it over to Kelly.
Thank you, Dustin. Hello, everyone. I'm Kelly Kim, covering the Korea consumer sector. So when I look at just the domestic consumption trend, definitely it's been very muted. We see that most of the negative same-store sales growth in the major channel that should be bad for the, I believe, the prestige cosmetic brands. Still online having positive growth, low single digit. I believe a multi-brand store also have a positive growth. So we see that more down trading happening, so more skewed to the mass brands performance better for the beauty brands. But for Korea beauty brands, rather than pure domestic trend, it's more important to the overseas market. Especially U.S. become much bigger market for the Korea names, and Korea became the largest exporter for the beauty to the U.S. market last year. So we have like over 50% growth last year YOY for the Korea export to the U.S. But when we look at the Jan and Feb number, there was a bit deceleration happening. So it was only early teens, 13% growth in the first quarter, much lower than the fourth quarter when you have a 40% growth. So the concern has put more weight on the share performance of the beauty names who has a higher exposure to the U.S. market during the first quarter. And also with this tariff news, the Korea will have 25% tariff levied. But if you think about the pricing structure of the cosmetics, the import price, the COGS of the cosmetic price would be much lower than retail price. We think 20-30% of the retail price. So this 25% tariff maybe bring mid-single digit kind of price adjustment, which can be, I think, more limited issues for the Korean cosmetic names. But today we see that the share price been somewhat affected because of this tariff concern. Actually, related to the China, we see that there are some expectation building for improving the Korea-China relation, which can reopen the China market for Korea pop and cultural content. And this could be more positive for Korean brands, which could leverage this for the marketing activities. But again, as Dustin said, we see that a lot of downtrading happening in China. So we remain cautious on the Chinese consumers' demand on the prestige cosmetics, especially for the like LG, H&H's Who, or Amore Pacific Seohasu. The sales recovery can be not really much materialized in the near term. And we've been also hearing that first quarter revenue trends would be not that much inspiring in China for these brands. And rather than China onshore, I see that the more concerning part is coming from the travel retail channel. So from the late last year, we see that major duty-free operators in Korea streamlining the reseller Daigou in downtown stores very aggressively to improve their margins. So when we look at the Gen and Feb travel retail, the duty-free revenue trend, downtown revenue sharply fell by 35%. Mainly from the cosmetic sales. We originally expected more like 20 to 30% revenue decline in the duty-free, but the trend is actually worse than expected, so that it can be actually giving more downside risk for the earnings who has a higher exposure to the duty-free channel, the travel retail channel. I believe such a weak demand is also reflecting the China end market for the prestige cosmetics, but also the U.S. dollar appreciation, because we're selling everything in the U.S. dollar in the Korea duty-free store. So that is making, I think, diluting the price advantage more in the Korea market. Let me stop here for Korea and hand over to the Sato-san.
Thank you, Kelly. So this is Sato of Japan. So I'm talking about Japanese cosmetics market situation. As a department store, cosmetic sales were plus 9% in February, and but minus 8.7% versus 2019. Cosmetic tax-free sales rose 60% year-on-year, a decline at minus 34.4% versus 2019. The inbound mix within department store sales was 23%, versus 32% for the same month in 2019, as trend stayed below peak levels. Meanwhile, domestic demand was minus 0.5% as year-on-year growth decelerated amid warning reopening demand. In 2024, the inbound demand of cosmetics at the department store was almost double year-on-year, but Shiseido's inbound sales just increased less than 20%, and Kose increased 30%. That means the Japanese brand became to be unpopular among the global luxury, even in Japan. We saw the long line in front of the Dior counter in Japan. When we see the trend by the price band last year in Japan, we still see growth rate of low price has been better than the high end. So we have seen that for over 20 years. In summary, what I want to say is that Japan sales growth for all cosmetics firms in this year could be slowed down from now. And about China, every company assumes low growth this year. Shiseido guides for a low single-digit year-on-year decline. Kose expect a roughly 10% decrease. About travel retail, Shiseido assumes a year-on-year decrease in the low 10% range, while Kose factors in a year-on-year decline of 30%. So Kose, last year, they write down the inventory in China at the end of the last year, but Shiseido didn't do that. So Shiseido assumed minus growth in China next in 26 too. Yes, this is it from me.
Thank you, Sato-san. This is Denise, part of our Delta One and Securities Lending Desk. So I'm going to quickly just go through the relevant basket tickers we have in the region and kind of really quickly the flows we have seen. So in the region, we have three main baskets to look at. The first one being Asia Cosmetics. The ticker is MSAP BUTY. This is our regional basket with 27 names, and it's skewed majority to 30% to China, Hong Kong, 28% to Korea, 23% to Japan, and 18% to Hong Kong. The second basket would be Korea Cosmetics, MSAPKRCS. This is essentially a liquidity-weighted basket with 14 of the more pure-play names we have selected by our QDS team. And finally, the last basket would be Japan Cosmetics, MSAPJPCO. This basket's also liquidity-weighted with 8 names also selected based on a purity score. So year to date, I think if you look at benchmark versus Asia Beauty, it has outperformed bench by actually around 9%, while Japan Cosmetics has underperformed by about 8%, dragged both by beta, but also pressured by more concerns on the U.S. market, kind of pressuring key names like 4922. That being said, what is relatively surprising today is the resiliency we have seen post the headlines yesterday, especially in Hong Kong, China, and all of our baskets actually closed relatively flat. This could be due to a greater domestic skew for Hong Kong, China names, and also positioning-wise, it's just definitely less crowded. While in Korea Cosmetics, I think it underperformed a little bit more, just given the larger U.S. market share and tariff concerns from overnight. And we do see this reflected very much in our short book. Our short balance has been relatively flat in these names in year to date, and actually we've been slightly better to cover. But we started seeing a short uptick in the last 3 days, primarily driven by the Korea players, including Amor Pacific, where we actually saw short flows up 91% with the short sell ban being lifted and demand kind of building up quite quickly there, likely as a tariff-sensitive play. But otherwise, I would say flows have been light on the basket's thematic direction since the reopening and the China-Korea visa trades, and overall we've been better to short, mainly as clients use our baskets as a sector hedge against selected single names. I'll take a pause here and then hand it back to Sharon. Thanks.
Thank you, Denise, and thanks everyone for the update here. I think we basically covered some market color and investor feedback, but it hasn't, dived into the individual stock ideas. So may I ask everyone to spend some more time on single names if you want to touch on, or some advice on how to, trade in the current market condition here. We'll go from Dara again. Dara, thank you.
Yeah, so let me start with the U.S. names. We don't recommend any of the beauty names in terms of Estee Lauder, Coty, or e.l.f. First, just the tariff situation. At Estee and Coty, there's a bit of exposure out of China from components, etc., but generally not a ton of tariff exposure, and there is pricing power in the industry. e.l.f. has 70% China sourcing to the U.S., 80% overall in China, but some of that goes to international markets that shouldn't be impacted by the tariff situation. Each 10% tariff has a 13% earnings impact, so obviously pretty severe. We've got another 34% U.S. tariff on China, in addition to 20% originally. To put it in perspective, they need to take 2.5% price for each 10% tariff increase. So obviously a big earnings impact on e.l.f. We'll see what they choose to do from a pricing standpoint. But I just wanted to cover the tariff piece of that to begin with. But I think the second piece of that is more the indirect impact of broader economic worries, a broader economic slowdown as a result of this. What I mentioned in the U.S. is that we've seen some pressure, particularly from the low-income consumer, particularly from a Hispanic consumer. But we have generally seen weakening trends across income groups, across demographic groups. I think clearly some of this stock market pullback and some of the worries about the economy and tariffs in general are impacting sentiment and spending. So that leaves us from a fundamental standpoint still pretty cautious in the group. And again, as I mentioned, there's a retailer inventory overhang beyond what we're seeing from a consumption standpoint. So to be pithy at individual names, Estee still in turnaround mode. Hard to be excited about the stock here, particularly given the external challenges. Coty, valuation has compressed quite a bit. They've had a successful turnaround in recent years, but they have been impacted by this category slowdown we're seeing, and the inventory issues have been even more severe for them than others in the sector. And I think e.l.f. is working through challenges of innovation this year and not having as much success. Again, the retailer inventory overhang in U.S. mass cosmetics should also limit the fundamentals in the next couple quarters here. And obviously, they'll be dealing with the tariff situation. So that's why we don't recommend any of the beauty names. I'll cheat a little bit and highlight very quickly some other names in my group that may be of interest to people. Coke we like as our top pick. We think the pricing power is stronger there than the rest of the sector. So that's Coca-Cola. We just upgraded Keurig Dr. Pepper, where basically their U.S. refreshment business in the U.S. has very strong pricing power. They're gaining share. They've done well in international markets also, and we think there could be a recovery in their coffee business going forward. Philip Morris is a way to play the shift to smoke-free tobacco over time, and that's not fully reflected in the valuation. And then also like Monster, where we're seeing a recovery in the energy category as they cycle easier comps with some pricing, innovation picking up, et cetera. So those are a few names in the broader staple space that we like, that we think people can own at this point. And I'll turn things over to Sarah.
Yep. Similarly, not enormously enthusiastic message coming out of European staples as regards beauty. Obviously, the big name here, or the biggest name, will be L'Oreal. As I flagged, they obviously they face very significantly difficult comps in the first quarter, particularly as it relates to sun care. They were recently on the road in the UK, kind of suggesting that, first of all, as we've seen, and as Dara talked about, the US is starting off more slowly. Europe, we can see this slowing down in cosmetics. And so we think growth in Q1, is likely to be probably sub 1%. They are still targeting beating the market with market growth of 4 to 5, but they've been flagging it's very second half weighted. And obviously they have significant exposure to the US, where all of this tariff noise is not going to help with the consumer, as Dara highlighted. So, they could be a beneficiary relative to e.l.f., say. In cosmetics in the US specifically, they lost share to e.l.f., so if e.l.f. has to put prices up, that could help them. But generally, we see, not enormously positive risk reward here. The valuation has obviously come down a lot, but it still trades on a meaningful premium to staples. And I don't think you're going to get any more confidence on the full year result after Q1. If anything, the risk is probably to the downside. On Beiersdorf, we're a bit more constructive there. We published an update yesterday kind of suggesting risk reward there is improving because that's sold off a lot. They do have a destocking event in Q1 in China luxury with La Prairie. So again, growth is going to skew towards the second half, and investors may not be minded to kind of take the risk now on that, but it does look better, and they do have a strong pipeline of innovation. Everybody's innovation seems to be coming in the second half, which is sort of slightly concerning. L'Oreal originally had said they would spread it through the year, but it seems to have been pushed back. And so actually the name we like best in beauty would be Intercos. Might be too small for some, but essentially, as I highlighted earlier, they are direct beneficiaries of a weakish market where cosmetics companies have to push for more innovation. They serve everybody. So the fact that the Chinese brands are taking share from the international brands in China doesn't matter. They grew at 28% in China last year against a market that was down slightly. It is small. It's a very fragmented industry. They are gaining share. So that would be the name we'd play. If anybody wants more details on that, just fire away and ask questions afterwards. I will hand over to Dustin.
Thank you, Sarah. So our focus stock for my coverage is Giant Biogene. So like, Sarah and Dara mentioned, there's certainly risk of the indirect impact from tariff because of the border consumption slowdown. But this company revenue was about like 5 billion RMB. So I don't think it has a lot of the exposure to macro. Still thinking this, either from the growth perspective or stock still having its own alpha. So just a recap, 2024 deliver almost 60% sales growth and the earnings up like 45%. And 2025, we think the company will deliver like 30% sales growth and like 25% earnings growth. The driver still being, I think, the recombinant collagen and advanced ingredient-based skincare still gaining popularity. And they are more like mass market positioning. And the good thing is that their new customers still account for about 60 to 70% of their key products. So suggesting they are still expanding to the new consumer cohort. And the company's product pipeline for both Comfy brand and the Collagen brand are still quite many this year. So a few catalysts we are watching out for. One is the upgrade of the collagen stick to sort of the 2.0 version. I think the new product will be launched soon, this week or next week. And all the preparation work for the channel, for the KOL, for the branding marketing is all done, and they are looking for the June 18 as a key event to drive this product upgrade. I do think this could be a potential stock catalyst for the near term. The ASP will be the same despite the ingredient upgrade, but company said that because the ingredient upgrade is for real, so they will reduce some of the discount and the promotion, looking for higher GP margin for this particular products. Another product that it recently launched is kind of a little small, the so-called Frame Range series, or in Chinese is called 真玉蜜修. So this product is quite special that it is targeted for the consumer who just using heat or energy-based aesthetic treatment to help that the skin to soothing and healing, and use their own exclusive recombinant collagen ingredient to do that. Originally, they only launched this product offline because that's related to the customer with the aesthetic treatment. But they see strong demand from online too. So lots of live streamer actually ask company to provide the products to let them sell. And so current this new product, supposed to be a small launch, but become out of stock, and companies are reassessing the market opportunity. And third is another brand, a Collagen brand. I think that's going to be a focus for the company too. So they're going to launch the new hero products on top of the current 4 products. And in terms of that channel, like Collagen didn't grow well in the past 2 years because the offline channel was a drag, but that already down to lower than 40%. And their online growth is accelerating. So we think the Collagen brand sales growth is actually going to accelerate in 2025. So put it together, they are still having very strong pipeline in terms of their product innovation. And we do think the growth runway is pretty long. It kind of delay its aesthetic injectable products so far because the regulator hasn't provided a green light. Company kind of stopped providing the new timetable for that new launch because this is really out of their control. But market didn't respond negatively this time, very different from what happened last year. So I think that also means that market is being convinced, even just within the current skincare segment, this company have a longer runway because very strong innovation, in-house innovation capability. Also because of that, on top of the upgrading earnings post results, we also upgrade our target multiple from 25 times to 30 times, and think continuous sort of surprise on the upside in terms of a new product launch will drive that re-rating. So that's our key idea within China Beauty. With that, again, let me turn it over to Kelly.
Thanks. Hi. So for Korea equity market with the short sale ban lifting from March 31st, we see definitely a good interest in the cosmetics name, a popular short candidate, especially given that a lot of concerning in the U.S. market and U.S. situation, we see that there is a good kind of demand for the Amore Pacific short selling. But also we see that Amore Pacific, their own brands such as Laneige, have a very good momentum in the U.S. still. They've been doing very good, successful new product launch during the first quarter, and also Amore Pacific introduced Estra, the number one derma skincare brands in Korea, to the Sephora US. So we think there can be pretty much doable to bring over 20% growth in the U.S. in the first quarter, even though they do have a very high comp base, especially in the first quarter. The issue is more with the COSRX, which is acquired brand, which has been suffering from the pricing policy change and offline channel strategy change. We understand the companies are more working on the sustainability for the brand positioning in the U.S. market. That is making the company have a very painful transitions from the middle of the last year, and that is making the weakening sales momentum, the decelerating growth momentum with the COSRX. And we see the investor turning much more bearish on the COSRX revenue outlook, continuously falling trend, more kind of, I think, a buy-side consensus at this point. But given that the company going to have also the more new product, new category introductions from the second quarter, we think a YOY growth momentum can have much more stabilizing from the second quarter, which can be more inflection point for the COSRX, given that a lot of transitional efforts are happening from the July last year. So second half, they should have a much more easier comp base on the YOY growth for the U.S. market. And also when we look at the overall the Amore Pacific earnings structure, other than the COSRX US trend, the brand performance momentum been very solid. So that is making we think, not really much downside risk for the earnings forecast itself, but still there is a lot of debate on the COSRX, which is more weighing on the valuations. So Amore Pacific is now trading at 18 times PE on 2025. And I believe this valuation is already reflected the weak momentum in the COSRX US trend. For the LG, it's trading at 15 times PE on 2025. So headline valuation looks more comfortable with the LG, but considering its cosmetic earnings mix is only 30% of total earnings, we think the implied valuation for cosmetics can be like 25 to 30 times at this point, which looks very demanding to us. But also if you considering that the earnings exposure to the travel retail market from LG Cosmetics, which is, I would say, 70% of earnings based on the last year, and having like 30 to 40% revenue decline, we think there are going to be more earnings downside risk on the LG H&H. So that is making us still more preference on the Amore Pacific versus LG H&H. Let me stop here, and the Sato-san will talk about Japan stocks.
Thank you. So about the Japanese companies, actually I have underperform rating on Shiseido and Kose both. I think negatives related with China are largely out, but U.S. sales slowdown of Japanese companies has emerged as a new concern for these companies. So Shiseido and Kose's American sales was declined in Q4 last year, especially Drunk Elephant of Shiseido was dropped sharply by 60%. But Shiseido assumes plus low teen growth in the U.S. business this year, and Kose sees plus mid-single digit. I think both are optimistic. But Shiseido recently, an activist invested in Shiseido. After that, investors started to hope something happen on Shiseido. So my rating on Shiseido could not most be worked. But for fundamentals, Shiseido has big possibility for write-down related with the U.S. business that related with the Drunk Elephant, goodwill amortization, and others. So among Japanese cosmetics company, I think the investors should be select companies which have large sales contribution of Japan could be better. So So I'm watching the Polar Orbis Holdings new strategy meeting in May or June. So I have a neutral rating on it, but I'm watching about that. So the most of their contribution is the sales contribution is Japan. This is it from me.
Thanks, Sato-san. Thanks everyone for the update. This is very comprehensive. We do see some questions coming through, so we'll address them one by one. Dara, I do have one question for you. I think during the presentation, you don't recommend any of the U.S. beauty names. Is there a time period when you think trends may bottom, and timing-wise, maybe a more interesting time to look at the stocks again?
I guess the pithy answer would be I think it's still early here. I think there are a couple things. There's some broader economic worries. This is a more discretionary group in general. So obviously that creates a bit of uncertainty going forward. But as I mentioned, beyond the underlying weakness, that's clearly pretty understood in the investment community with all the stocks far off their highs. I do think you have a retailer inventory overhang here in the next couple quarters that makes the reported trends worse. And I think just high level, Estée in the middle of a restructuring, the external environment makes that internal restructuring more difficult. Coty, despite the good restructuring work they've done, again, the inventory issues are more severe for them. And in e.l.f.'s case, with innovation not working as well this year, which has been so important to their historical market share gains, but now the tariff issues on top of it, you have a lot of uncertainty. So I think we're not necessarily at the later stages yet when you put all those things together. So again, we're more focused on other names in the Staples group, as I mentioned earlier.
Thank you, Dara. Another one from the audience here, right? Do you have any thoughts on e.l.f.? Is competition, getting fierce, or just the demand slowdown overall?
I think historically what you've seen from e.l.f. is tremendous market share gains. We've seen those gains really dissipate this year. Market share is up only slightly. If you think about their momentum historically, innovation has been a key driver. They've been very strong with marketing in terms of increasing marketing over time, but also the effectiveness of marketing, and then shelf space gains at retail. I think the biggest change this year is they haven't had as much innovation success. And what we've seen, if you go back over time, they've had sort of 7 out of 8 great years in the last decade. But there was a year where innovation wasn't as successful, and it took them a few quarters to sort of work through that and get the business back to the share gains it was historically. I think also remember they're at much larger share levels than they were historically, so it gets harder to continue to innovate and gain share as you get to higher levels. So I think you've had that issue. And then second, we've had weakness in the category. And again, some of that is compounded by retailer inventory weakness. That's particularly severe in beauty and particularly severe in the U.S., given the drugstore channel has been under such pressure in the U.S., and we've seen a share shift to other lower price channels. So that's causing particular issues. So I think you've got a combination of market share slowdown along with category growth. But from a market share standpoint, I think a lot of that has been related to the innovation cycle, and that's going to take some time for them to reboost in our minds.
Thank you, Dara. Sorry, I got another one for you. How likely do you see consensus to be revised down further on the back of heightened expectations on the U.S. recession following the reciprocal tariff headline this morning? Any of you here? Thank you.
I mean, look, I think clearly numbers are coming down, right? It was the case already due to all the reasons I mentioned. I won't go back through them, but I think we were looking at a case where earnings numbers were going to come down in the broader market. With the tariff situation, there's a direct impact to e.l.f. that's obviously pretty severe. We'll see what they choose to do from a pricing standpoint to help offset some of that. but clearly you're not likely to get, a full offset. And there's some level of demand elasticity, even though it's pretty low in this group. But look, I think what I point to for the beauty group in general, beyond the direct tariff exposure, is just that this causes broader economic worries. It's obviously a pretty fluid situation. I think the market, was somewhat ahead of sort of the base business earnings risk, but now tariffs obviously adds another level, and this is beyond the expectations. But it's also sort of a fluid situation. So I think it'll flow through probably slowly to consensus numbers, but the market's at a different place than consensus and ahead of it. And I think we also have to acknowledge that the situation is a bit fluid and some of the potential tariffs can change quickly. So that's why we're sort of within the group. We look at some of the names versus each other, and instead of taking a resolute view around the overall tariff situation or macro environment. So hopefully that's helpful.
Thank you, Dara. That's all I have for you for now. I got a question for Sarah. So Sarah, could you provide some color on the innovations from L'Oreal in the mass market and the prestige space to drive demand, and any sense if they will or have been resonating with consumers, please? And also, can you comment on how L'Oreal growth is likely to trend through the year? Thank you.
Yep, sure. So, well, unfortunately, I can't really answer the question on innovation. I mean, for competitive reasons, they're obviously not saying exactly what's coming. What we see is quite a lot of stuff coming out of the sort of tech developments in terms of skin analysis and things. And there'll be the trickle down of the molecule that they launched last year in terms of dark spots. So that should trickle down through the different sort of product ranges as it becomes more mass. But they haven't given a whole lot of information about what the innovations are. We see some stuff coming out of Maybelline, for example, in makeup. But other than that, there isn't a pipeline published somewhere that we can really look at for competitive reasons. And what I would flag is that last year they blamed their slower growth on the fact that their innovations had come a bit late in the year, and they were suggesting that this in 2025, the innovations would be more evenly spread through the year so they could capture growth and sort of so on. But actually, their kind of commentary in the last few weeks has been suggesting that innovation is going to be more second half weighted. So it feels like the pipeline may have slipped anyway. One obvious innovation that we do know about is they've taken over the Miu Miu fragrance license. So that's new for this year. So that would go into Luxe. But otherwise, like nothing specific that I can flag up. Generally, though, they have been talking up just the level of newness to try and stimulate demand. And as far as growth is concerned, we've always anticipated a slower first half and second half. Part of the reason for that is, we're seeing this for staples generally in Q1, there's one less day. So for something you put on your face every day, that's nearly a 1 percentage point of volume impact. So Q1 was always going to be quite tough. But additionally, L'Oreal has some very tough comps related to the fact that last year they were doing an ERP system switchover. So they pulled forward about 130 million euros of revenue from Q2 into Q1. So that makes Q1 a very hard comp, just mathematically. And they also had very high sun sell-in. It was up north of 50% last year on north of 50% the prior year. And then obviously this is mostly in Europe. And then the sun was not very strong. So sell-in in Q2 was flat and sell-in on sun in Q3 was negative. So Q1 is very tough. We think growth will be sub 1% for the quarter. I can see a scenario where it's closer to 0. And I think that the buy side is probably certainly well below the sell side. The sell side is still at close to 2. I'm sure that's too high. As far as subsequent quarters, you do have this artificial benefit in Q2 from the revenue pull forward that went into Q1. but certainly the comps generally are still tougher just in terms of market growth in the US last year, market growth in Europe, and it is slowing. So the risk is clearly growing that you do not get enough of a hockey stick in the latter part of the year to make the full year number. Consensus right now is about 4.5% for the year, versus we're on 4.1, 4.2 now. Those numbers do seem to be coming down, and obviously this was all before tariffs potentially impacting US consumer confidence and individual economies. L'Oreal is not the only one with a second half weighted profile. Beiersdorf also, they've got a tough Q1 because of the destocking in China, and their innovation pipeline builds through the year too. But definitely, there is heightened risk, I'd say particularly around L'Oreal, as far as meeting the full year, just given how soft Q1 is likely to look.
Thank you, Sarah. Appreciated the color. Moving to Kelly. Kelly, I got a question for you. I think March export data just came out, which was better than the first 2 months. Do you think the solid data is just a one-off or could sustain in the near future? And also how to think about, Amor Pacific, and the whole sector under the context of the U.S. growth slowdown?
Yeah, sure. So March number was better than in Jan and Feb. We see that like high teen kind of growth versus Jan and Feb was more like 10%-ish. But there can be also some one-off, given that this tariff is coming. Maybe the companies more kind of try to do shipments into the U.S. before the tariff is executing. So I think maybe that is making the both March and April number itself can be a little bit more kind of artificially kind of having these technical issues. But generally, given that, as Dara said, the slowing momentum in the beauty demands in the U.S. market, especially for the mass segment where the Korea companies are exposing. And also given that we have a very, very high comp base starting from second quarter last year. So YOY deceleration is, I think, it's definitely more inevitable. So we're looking at from the second quarter to the end of this year, more looking at like early teens kind of YOY growth for the exports number, which would be, I think, more in line with the buy side expectation at this point. But still, the tariff is one thing, maybe giving more kind of swings in the short term, the volatility. Regarding your questions on the Amore Pacific, we see that like the situation the companies are having for their earnings versus the valuation is very similar in the past 2 quarters. They're meeting or beating the expectation in the earnings because AP brands are doing much good job, including the U.S. situations. But because of the revenue trend in the COSRX is more kind of giving the growth outlook, so it's more the valuation arguments that's been actually making the range bound of the share performance so far. So we think maybe the first quarter result would be pretty much similar. They're going to be mid or slightly better than expectation in terms of the consensus earnings. But as long as COSRX having such a weak number, especially for the U.S. revenue, we think our share price would be much more in the sideways. So that's the situation. But as I said, we're going to having more stabilizing trend in the U.S. for the COSRX because even the demand is maybe more the decelerating into the second quarter and third quarter for the overall the U.S. beauty demands. But COSRX having their own company-specific issues with all these transitions. So that should be making more company-specific, I think, the revenue trending into the second quarter and the second half. So we think second quarter would be a much more interesting quarter, more positively for the Amore Pacific.
Thank you so much, Kelly, for the color. This covered all the questions we have, and thanks so much, everyone, for staying, this long on the call with us today. So please reach out to your Morgan Stanley, salesperson for any follow-up questions you may have. We'll speak soon. Thank you, everyone.